Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. On this podcast, I'm on a mission to empower you financially. I am a columnist and a journalist, an investor, a financial advisor, and the mum of a toddler. But I do not claim to be the font of all knowledge. I'm still figuring it out too. And that's why I'll be bringing you the experts and mining their big brains for all the things you and I need to know every week. It's one of the biggest financial commitments you'll ever make, buying property. And in this country, it can be really difficult to achieve. For most of us, the most important first step is to qualify for a loan, a mortgage. So how do you improve your chances of getting the lending you need to be in the game and with a foot on the ladder? And what do you need to know about what you've signed up for? Joining us today is Director of the Loan Market and Senior Advisor Cam Marcroft. Kia ora, Cam.
Kia ora, Nadine. How are you?
I'm great. Thank you for joining us. I wonder if we could talk about some of the fishhooks that trip people up on the way to getting a mortgage. Maybe if we could start with credit cards. What is the impact of having a credit card? Because as I understand it, it's not just about having credit card debt that's the issue, but sometimes just about having a credit card.
Yeah, you're absolutely right. So with a credit card, people have a limit, and the limit is what the banks use to put against your expenses. So general rule of thumb is about 3% of that limit. So if it's a 10K limit, $300 would be put against their expenses every month. So what it does is it just drags their borrowing ability down a little bit from that. So when you're looking to buy a home, we can reduce limits, we can do away with credit cards, and it might just be a little bit more of a lift just to get them to the level they need to get to.
That's good. That's a useful thing that you can kind of actively pull that lever to make a difference. What about student loans? Because for a lot of us, having a student loan might well cross over with when you're trying to buy a house. How much of an impediment can they be?
Yeah, the student loans are like, you do have to make big, large payments to your student loan when you're working, and that's part of the agreement when you take out a student loan. They are one of the best loans you can get because they're 0% interest. So on one side, we don't want to get rid of that loan, but if it is affecting your borrowing calculator, yes, being able to get rid of that student loan, that's not just, people don't have that option just to get a gift and to get rid of it. But a student loan can impact, again, how much you can borrow.
So maybe you'd weigh up whether am I better having slightly less of a deposit and clearing the student loan so that 12% of my pay packet isn't going towards repaying it every week.
Yeah, great call. So you could do that. And it's a tough one to do because going back to that 0% versus now I'm going to be paying a mortgage of maybe 6% on that amount, it is tough. But it could be the difference between getting that home. So yes, it is a calculation to work out. And if we can keep the student loan, it is better. But obviously, it'll depend on how much you want to borrow.
Yeah, horses for courses. What about other red flags? When the bank is looking through my situation, are they going, she in 2014 she was late paying her power bill, or is it that I've got buy now, pay later debt, or at least facilities? What are they looking for?
Yeah, so starting with your credit report, which is basically, have you been a good person around your account conduct? If you've missed payments for, your phone bills or electricity or whatever it is, and you've continued to ignore those messages, so they've gone to the VADA, the Bay Corps for debt recovery, that's not a great look. And banks really want to understand what's happened. Now, they will allow a letter to say, hey, this is how it happened, and we can, if you've got a good explanation, like you moved house, didn't get the letter and something like that, you can get past one, maybe two. But banks will start to see a trend once they see more than that. And that trend is where they're starting to see the client and say, hey, really, do we want to lend this person some money if they're not really going to honour our payments.
Is there an opportunity to kind of rectify that by showing good financial management for a period of time, or does that black mark stay on against your name for a long period of time?
No, definitely time will heal those. You can come back from that and say, I was young, I didn't understand it so much. You can grow patterns into your habits to get way better with money. So the banks will definitely look at it, but if they can see that you're starting to improve and show far better financial decisions, then yes, they're going to give you a go.
And look, it wasn't that long ago that there was the change in the legislation, the triple CFA, I won't try and remember what the acronym stands for, where they were looking at your Uber Eats and your trips to Kmart. Is it that prescriptive anymore now that those changes have been wound back?
Thankfully, no. Yes, and that was a time where...
it felt quite intrusive, didn't it?
It did cause a lot of issues, and it was a lot of more admin for everyone to try and come to grips with it. These days, the banks take a pretty sort of open view of it. Look, if you're spending large in a certain area and showing certain trends in these bank statements, it's really important for us to provide commentary around, hey, we went through a phase where we were doing this. However, with the commitment of buying a house, because we were spending that money because we didn't have many commitments, now we're getting into a large mortgage. We know damn well we can't spend there. We're not going to. And so it's just around building that picture for the clients to hopefully prove to the bank that, they are ready for this mortgage.
Yeah, it's like saying, I promise I'll be good. I'm a grown-up now. I'm taking on a mortgage. I'm wondering about the size of the deposit, because most people go, if I haven't got 20%, can I even do it? How possible is it to get lending if you have less than 20%? And what conditions or hoops do you have to jump through that are different than if you do have 20%?
Yeah, great question. So absolutely, 10% deposit, and in some cases 5% can buy a house. Now, when I say in some cases 5%, there is a certain product out there that you've got to fit the criteria. Generally, your income can't be too high. It's a government-backed loan, so 5%. But everyone else sits around that 10% is the minimum, 10, 15, 20. Now, if you've got less than 20% deposit, the terms are tougher for you. You need a valuation generally. Okay, so going to an auction makes it quite difficult. As well as that, the bank's going to add on a low equity premium onto your interest rate. So your interest rate's going to be higher. And that's their insurance for taking on loans that have less than 20% deposit. The other thing is the cash contribution, which is quite a good thing out there at the moment for punters wanting to buy a property where banks are giving cash contributions to pay for legals, all their costs. That tends to be a lot lower when you've got less than 20% deposit. So there are options, but it is slightly more challenging, unfortunately, for those people.
It's good that there are options, though, right? You don't have to throw your hands up, because 20% is a huge chunk of change in many parts of the country. So I guess there's a message of hope there. Are you seeing at the moment more first home buyers emerge as, property prices have come down and now interest rates are too?
Yeah, absolutely we are. In fact, the levels of first home buyers, I think in this last probably 6 months for us have been very high. The market has come back, so it's playing into the first home buyers' hands. The lending criteria has got a little bit easier. Now, the rates have dropped as well. When the rates are dropping, it also means that the test rate that the banks use to assess you drops as well. Okay, so that means when it drops, clients can borrow more. So first home buyers, it is a great market for them right now.
And are the banks all that different as to how they treat first home buyers, or are they all much of a muchness?
They vary from bit to bit, right? On average, they all have their different sort of offerings, but they have a few little changes in each bank there that might alter where we would put a deal.
Because you mentioned the low equity premiums, and I've done a little bit of work on those before, and they all are slightly different. Are they negotiable? If you can establish you're a good prospect, but you just don't have 20%, can you negotiate that premium so you're not paying too much more in interest?
They're very difficult to negotiate on the low equity premiums. Generally, banks have them there for a reason. So they probably prefer to negotiate on other areas, but the low equity premium can be pretty tough to negotiate on.
And then in terms of getting rid of that, is that simply either paying your mortgage off faster or house prices appreciating so that you do have 20%?
Yeah, it's important to have a plan. So as soon as you take that property out, it's when we're sitting down with our clients, we want to understand realistically when we think they might be able to get to 80%. Because when we get to 80%, it's a brand new world out there. There's so many options for them. The rates are much better, the cash contribution, so they may want to consider a new bank at that stage. But fixing in what period to fix into will give us the time frame to hopefully get them to 80%. Property prices increasing is one way, and debt reduction, as you mentioned. So the quicker that can happen, the quicker they can get to the promised land.
Yeah, it sounds like you'd think the hard work would be over once you have settled on the house, but it's almost like that's when it has just begun. We're going to talk a little bit more about the process of actually going through the loan application and pre-approval and all of those things, but we're just going to take a quick break and be back with Cam Marcroft after this. Welcome back to the Prosperity Project. We're with Cam Marcroft from the Loan Market, talking about how to improve your chances of getting the finance you need to become a first-time buyer. Cam, I wanted to ask you about what is actually involved in the process and how long you need to allow to get an application over the line, because the temptation is to go out and start looking at houses and fall in love with one and then go to the bank. But I presume it would be better the other way around.
Yeah, it is. And unfortunately, we do see those times where people go shopping without the check booked, really, to understand what they can buy, which then turns into an emotional roller coaster, because when you buy a property, you can already see yourself moving in. Now, there might be a finance clause that's thrown at us. And look, generally, you get them across the line, but we always recommend you must get a pre-approval. Understand what your limits are. It also helps you when you go into auctions or negotiation. Just do your prep, because in an environment when you're looking at a property, you do need to move quickly sometimes. And for an application to start, to answer your other question, how long will it take? Today, the banks are unfortunately painfully slow. And, you can push urgent stuff up and get it across the line a lot quicker. But if it's just generally sitting in the bank and there's no urgency, they can take up to 2 weeks. Luckily, they will turn something around very quickly if we've got an auction or if we've got a finance state to work with. But pre-approval at the very start, getting organised, is going to make the process much less stressful for our clients.
Yeah, the stress involved in working to the deadline and waiting for the bank to come back to you adds a dimension that you probably don't need at a time like that. Talk to me about pre-approval. So I've gone to the bank, I've given them the best view of my financial situation, and then they say, you can borrow this much. Is that I can borrow that much for any old property, or do I then have to go back to them and say, hey, I want to buy this property, and they kind of confirm those numbers?
Yeah, so the pre-approval is literally just saying we will lend to this amount, but it's conditionally on the property that they find. So every property that a client then looks at is really important that that property is passed on to the bank for final approval to be unconditional. Banks won't lend on a property that they're not comfortable with. A classic example will be your monolithic cladding built in the 1990s that might have moisture issues. Banks will not go near those properties generally, unless, especially for first-time buyers, unless it's people with money that are going to develop them and do something with it. So it's really important that the property gets ticked over by the banks before you go unconditional.
So therefore, in the process of buying the property, there must be some non-negotiable expenses that you need to be budgeting for. And I know that particularly when a first-home buyers go to auction, as you said, they'll often have to get a valuation for a property that they're not actually guaranteed to get at auction. So are there costs that you're advising people like, hey, set aside this much for a valuation, a building inspection, a lawyer, whatever else?
The valuation is a really tricky one because it's an investment before an auction, which can cost you, anywhere from $1,000 to $1,200 to actually get someone's opinion on what the house is worth. You could rock up to that auction and the first bid is over that amount. So the first time buyers, it makes it really tough. So the same with solicitors and getting due diligence done, highly important. There are costs. This is a big ticket item. We're not buying a pair of shoes. We're buying a house. So people need to do their due diligence. The valuation and auction for first-time buyers, it's probably the reason why a lot of first-time buyers go for properties that are by negotiation, or they wait for them to be passed in before to go for them. But we do have people that will do a valuation each time to go down that track. The solicitor due diligence is, like I say, very important. piece to the puzzle as well.
Yeah, because there's lots of legalese on the limb and the like that you need to understand. And like you say, this is a big ticket item. Speaking of auctions, do many at the first home buyer level go to auction these days? I know there was a period of time when the market was hot where everything was auction, but is it more toward the buy negotiation at the moment?
First home buyers are still going to auction. Now, remember, we're only talking about the people with less than 20% deposit. Amazingly, there are first-time buyers out there with more than that, even in that Auckland market, and that's probably because they've got student assistance from other people. Bank of Mum and Dad's pretty popular, right, with gifting, but it also can be a guarantor where they're not having to give any money, but they're giving a slice of their property, which is equity. And that's quite a good technique to use with first-home buyers when they go to auction as a backup option to say, hey, we won't get the valuation because we have the parents who will do a guarantor solution for them if successful. And then after the auction, we can go down that guarantor option, or they could choose to get the valuation done and go on their own. So that can be another way around it.
So you don't actually have to have that confirmed ahead of time. You just have to have the option on the table, and then maybe if the valuation stacks up, you do have 20%.
Yeah, so we would definitely have the guarantor option approved before they go to auction. It's really important that they have some form of unconditional offer from a bank before going to an auction. When the hammer comes down, if they're the highest bidder, they're buying that property. So really important that we explore all options and avenues for our first-home buyers, because sometimes it's, they think it's just, there could be other options where parents might be able to give them that extra 20, 30K if they needed to get the 80% or so be it.
What about KiwiSaver? Because, there's been huge amounts of money pulled out of KiwiSaver to assist first-home buyers. What do you need to know about the process when it comes to buying of accessing those funds for your deposit?
KiwiSaver is great. I think it's a great concept, and it's helped many first-home buyers get into their first home. The key thing with the first-home buyers when you're using KiwiSaver is that you do need to allow a little bit of time. So when you've bought that property, a quick settlement it can cause a lot of grief. The solicitors tend to take up to 2 weeks. They probably get it out a lot quicker, the KiwiSaver, for a settlement, but they do allow up to 2 weeks to get that money out. The buyers can leave. They can take everything and leave $1,000 in there. That's the requirements, but it's a really good option to building that deposit up faster. So clients have that ability to put more than 3% in when they're building up their deposit, and we encourage them. It's tough with KiwiSaver at the moment. They're probably going through a bit of a turbulent time with old Trumpy and all his stuff going on, and those KiwiSavers have dipped down a little bit, but putting 8% as opposed to 3% into your KiwiSaver, it's a fund that you can't touch, and an investor's trying to grow that. It's better than putting it into the savings account.
Yeah, and I guess particularly at times like this, it's worth reminding people that if you are intending to access it soon, you have a short investment horizon, and therefore you need to invest conservatively, but a separate issue. Hey, we are planning on doing a future episode on the likes of shared equity schemes. Do you come across many first home buyers that are utilising either government-backed schemes or private schemes or council schemes that help first home buyers?
We come across a little bit of them. Like it's actually a tough. A lot of the schemes that we've seen, especially in the Auckland market, which would be a big part of our database. A lot of people tend not to qualify for those schemes, but they are amazing and they're great for people to get into them. We have some clients around rural New Zealand that we've got into it with them, and they're at the stage now of maybe trying to buy them back out and get that house for themselves, which is pretty cool.
It's much more common these days to not necessarily just have one employer, but maybe have a portfolio career or be a contractor or a freelancer or self-employed in some way, shape or form. What does a self-employed person need to know and do in the loan application process that someone who's just collecting a salary or a wage each week doesn't?
Yeah, it's nice and simple for PAYE because the bank knows what you're getting each week, fortnight. With self-employed contracting, it's a bit tougher. The bank wants, at the end of the day, they want to get confidence in that income you're earning. And it's really difficult without seeing a full set of financials. So what the accountant can provide, depending on how long they've been in the business, 2 years of full financials is the ideal. Anything less than that, that comes down to the story and what they're doing and how successful they're going. There's no reason why a business less than 12 months can't get a loan. It's just a little bit tougher. The bank will need to see time to evidence that consistency of income.
So I suppose if you are sick of your job and thinking of packing it in, but you also want to buy a house, maybe you could delay that, going self-employed, starting a business until you've secured the lending. Would that be a smarter way to do it?
Yes. However, with part of your application to a bank, there is questions there that people need to answer of. Are you looking to change anything with regards to your financial position? So that's a tricky one that people, I think, need to make a pretty common sense decision when they're taking on a large level of debt, that if they are going to give that income up, they'd have to be pretty confident in the new
business idea. Yeah. So you get the lending over the line, but you actually still have to pay it. So
correct.
Maybe it's not the right time to become self-employed.
Yes.
You mentioned things being busy out there in the market at the moment. Should that put the fear of God into first-home buyers, that you think the market's going to take off in some respect, or is it still sort of measured and prices under control?
Yeah, look, it's interesting. We've been noticing the larger level of applications being submitted at the moment, and then you read the papers and it's pretty doomy and gloomy out there in the economy. So it's quite a fascinating position at the moment. I don't see property prices rising in a massive boom. I don't see that probably happening again for a long, long time. I really think we'll see a gradual climb in property prices. It has to with the activity levels and the interest rates decreasing. That's bringing activity in. So I think it's still a pretty good time to be buying. I think later on this year, you probably might start to see a bit more of a pickup. But I think at the moment, there's plenty to buy, there's plenty to choose from, and the competition, although there's a lot of applications, it's not too hard at the auction rooms yet.
Well, I mean, that's a relief, because if you've studied the property market over any length of time, when it gets frenetic, the first home buyers are the ones that suffer because they can't save enough to keep up with the increase in property prices, and then they make rash decisions. So I'm reassured by what you're saying. Thank you so much, Cam, for explaining and demystifying some of the aspects of becoming a first-home buyer.
No worries. Thanks for having me.
Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories. nadine.higgins at nzme.co.nz. A reminder, though, that this podcast is informational only, and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.